Yellow Limited, a public company following IFRS 16, decided to upgrade the coffee machines in all of its office locations. Yellow leased 50 machines from Coffee Time Limited on July 1st, 2020. To purchase the coffee machines instead would have cost Yellow $350 per machine, and the machines would have lasted an estimated 5 years. The lease calls for semi-annual payments for the next 3 years in the amount of $40 per machine. The payments start on July 1st, 2020. At the end of the 3 years, the machines will have to be returned to the lessor. Discuss how Yellow should account for the lease and prepare the entry for the first payment on July 1st, 2020. Would your entry for the first payment differ if Yellow followed ASPE? Okay, so let's figure out what we're talking about here in terms of dollar values. So we've got, the first thing I'm going to check out is we've got 50 machines. 50 machines. And we're going to lease them for, $40 per machine is the lease. So let me change this actually. Let's put this here, $40 per lease. So our amount here is going to be 50 times $40, which is going to be $2,000 twice a year. So they're asking us to prepare the entry under IFRS. Now, what do you think? 50 machines, $40 per lease, individually $40, a total of $2,000. Now, the thing we need to remember about IFRS 16 is that IFRS 16 captures basically everything as a right of use asset, except for short-term, so less than 1 year. So this lease is not less than 1 year because it's a 3-year lease. But is it of low value? I would say yes, definitely. $40 per lease at $2,000. This is a low value lease. So therefore, we're going to account for it as an operating lease, which means our entry for July 1st, 2020, first lease payment is going to be debit, low value lease expense, which is going straight through our income statement. So we're not putting an asset or a liability onto our statement of financial position, and credit cash. And these payments, this is going to be 2,000 that we calculated above and 2,000 below. So that's our entry under IFRS 16 because it meets the criteria of a low value lease. And then it asks us, how would our entry for the first payment differ if Yellow followed ASPE? Okay, so for ASPE, we have criteria. We have 3 criteria to capitalize leases, 3 capitalization criteria. Need to meet 1. So let's see. So first is transfer of ownership. So is there any reason to think that these machines will transfer to the lessee at the end of the period? It says in the statement, at the end of the 3-year period, the machines will have to be returned to the lessors. I'd say no. There's no bargain purchase option or any reason that we think the title is going to pass. The second option is if the lease term is greater than 75% of the economic life. So let's see what's happening with that. So our lease term we know is 3 years. And it says that if to purchase the machines, and the machines would have lasted 5 years. So we've got 3-year term, economic life of 5 years. 5 years. So let's see here. So if we go 3 divided by 5, that's going to give us 60%. So it does not exceed the 75% threshold. So no, not met. And the third criteria is if the minimum value, or as if the present value of the minimum lease payments is greater than 90% of the asset's fair market value. And I don't think we have all the inputs that we need to calculate the payment. So we've got a payment of $350. So let's see, what do we have here? So we've got, do we have an I in this $50 per machine. Payment start in July. We don't have enough information to calculate the present value, but what we do know is that the non-discounted payments are $350, right? And so the discounting of the payments, $350 per machine, we don't have this information, so we're going to assume it's not met. So therefore, oops, let me just change this. No. So therefore, no criteria met. Actually, this should say no criteria met. Therefore, operating lease. Which means it's the exact same entry that we had above. We just have to go through a whole other process to figure out if it's operating or capital. And then we're going to have debit, operating lease expense, or lease expense, something along those lines for 2,000. It's not going to be called low value, and credit cash. And that is what the answer to that question looks like. So under IFRS, we would debit low value lease expense, and that's because this lease is only for $40 per machine, total of $2,000, so not material, arguably. And under ASPE, we're going to end up with the exact same payment. And we just have to figure out, we have to go through the capitalization criteria to make sure we wouldn't capitalize it. Then if we're in an operating lease, we're in the exact same entry. Our account is just different. We're going to have operating or just lease expense, something to that effect.